from a vendor or broker's perspective, you want to make sure that you're the guy who wins in the event of a merger or a business combination or other competition. And vendors, having been one, I can tell you that vendors count on the difficulty of replacing mission critical software.
Hello, and welcome to At the Forefront Fintech Conversations. I'm Sam Belden, VP and Head of Content at Forefront. And with me today are two financial services consultants who bring two distinct perspectives on our industry. Jeff Estella is principal at Estella LLC, where he consults clients based on his background in asset management, while Michael Cashel is managing partner at Cap Markets IQ, where he consults clients based on his experience in the brokerage, ATS, and technology space. Gentlemen, welcome to At the Forefront.
Thank you. Appreciate you having us.
Yeah, thanks for having us.
Of course. So today we're going to discuss some key financial services and more specifically capital markets initiatives for 2024. We'll talk about some liquidity trends on both the buy and sell sides, and we'll talk a little about the state of investment technology and data. Be sure to stay tuned for that. But before we get into those topics, so many initiatives in the capital markets to focus on in 2024. We have new regulatory priorities, T+1, a lot of activity in the digital asset space, and all of this is happening while everyone faces continued cost pressures. So as we look at all of this, tell us a bit about what you and your clients are prioritizing in 2024.
Sure, Sam. Thanks for the opportunity. My clients that I'm working with now are focused on a number of things in 2024. From an asset management perspective, it's certainly shrinking margins. What does it mean in this active passive fight? What does it mean with the open-end mutual fund outflows? Those are two key questions that continue to focus, to be a core focus of my asset management clients, and I'm sure others within the industry as well. With cash yielding 4 to 5%. How does an asset manager lure a client away from, treasuries and CDs back into active or passive management? Ongoing question. M&A, mergers and acquisition. What does it mean going forward? We saw the Putnam Franklin Templeton deal, a couple in the wealth management space. What could happen in 2024 and beyond that, and the ramifications around that. The core asset owner client, how do they get impacted? Is this accretive or dilutive to them? What does it mean from a vendor perspective or a broker perspective that have been servicing those wealth management and active and passive asset managers? And then on the outsourcing side, a phrase that I use with many of my clients and prospects is, do they have a desire to stick to their knitting? And what I mean by that is they have a core offering. If it's alpha generation and distribution, if that's their core offering, everything else potentially could be in a conversation for, supplemental or an outsourced relationship. And then on the product delivery side and, investment vehicle, is an ETF the right wrapper? Is a separately managed account the right wrapper for tax benefits? Is there going to be a new product in the future that could be the right wrapper that's going to continue to challenge, legacy? And then speaking of wrappers, the wrapper around all those items that I just mentioned is a governance model. If there isn't a strong governance model from people, process, and technology, all of those items that I mentioned earlier could certainly be at risk.
Mike, great. Well, I'll jump in on the sell side. I think that the big issue that everybody's focused on right now, of course, is T+1, and T+1 goes into effect May 28th of this year. I think that the media has covered the software issues around T+1 very, very well. What's not, I don't think, being discussed to a great extent anyway, is how is the buy side going to finance itself given T+1? And so, do you see them turning towards pre-funding? Do you see them doing inter-fund lending, bank loans, overdrafts? Will we see people carry bigger cash buffers in their portfolios? Will we see a bigger usage of swaps, futures, trading on adjusted settlement, those kinds of things? And then ultimately, does this increase the demand for short-term securities lending? Do we see staff relocations into the United States where this is going to have the biggest effect? All of this stuff comes at a cost, and as Jeff mentioned, it's coming at a time where margins are further being compressed. If you look at the European and Asian managers, who are used to slightly longer settlement cycles. How does it change the ETF create redeem process? How do they do their FX hedging, cross currency flows, cross time zone trading? So there's an awful lot going on there. A big focus is affirmation management. DTC, Match to Instruct, Fidessa's AMS product, Broadridge, all, for example, have very big focuses on affirmation management technologies. The shorter settlement cycle is going to certainly increase fails. It's going to increase recalls. It suggests the need for much more automation in terms of securities lending facilities, but it also suggests the need that automation creates more, more focus on transparency. And then let's turn to the SEC. The SEC is talking about new transparency regulations. And if you couple that with increased levels of recalls, shorter duration loans, does that increase the amount of information leakage that goes out from beneficial owners like mutual funds and pension funds? And as a portfolio manager, are you willing to risk alpha for short-term securities lending revenue? So not sure of the answers to those things, but I think those are the things that people ought to be focusing on. And while all of that drives more volume from a securities lending perspective, I wonder whether there's going to be some kind of a knock-on effect in terms of overall liquidity.
And from the buy side perspective on T+1, when you really think about a global portfolio that has different settlement cycles depending upon the region of those securities, it's vital to manage the cash neutrality. An asset manager can't be, overdrawn or ideally have to, have too much cash and have that cash drag in rising markets. So really thinking about that forward calendar on the settlement cycle and the unification on the T plus question mark, if it's 1, 2, or otherwise, is a vital point. And Mike touched upon, the DTCC's report on the affirmation goal of hitting 90% on trade date. That is going to be a core goal of all parts of the ecosystem.
Great. Thank you both for that overview. No shortage of issues at play, obviously. So now that we've kind of discussed some of the basics that your clients are looking at in 2024, let's take a look at how some of these market participants are actually interacting with one another. So when it comes to liquidity, what is the sell side offering? What is the buy side consuming? What can you tell us there?
Yeah, it's the liquidity du jour, right? So this is the never-ending quest. The buy side continues to be more sophisticated than ever. It's a year-over-year sophistication growth, and that's complements to the buy side and the tools that they've subscribed to, and the dealers they retain. Greenwich put out a report recently that 44% of the buy side's orders had some type of electronification to it in 2023, and that's interesting, and that continues to grow year over year. Some of these buy sides, are focusing on dealer relationships, and those dealer relationships and which ones do those dealers have with certain single dealer platforms. And that's unique liquidity in the marketplace, and how you measure that liquidity and the value of that is vital. The gift that keeps on giving, the ongoing debate of volume versus liquidity. And this is through the entire life cycle of an order. So it's, order creation, that portfolio manager, the execution, trading desk, the measurement of execution, and the rinse and repeat. For a portfolio manager to see X amount trade on the tape and ask their trader why they haven't completed a certain percentage of that order. So volume certainly doesn't equal liquidity, and the buy side continues to educate portfolio managers and analysts what that truly means. On the point of measurement, you can't improve what you don't measure, and that's that ties to a lot of things in life, and in particular, trading. And so measuring trading, looking at large sample size over multiple market cycles, leveraging both internal and external tools to help look at it from different perspectives is only accretive to reducing trading costs. And there are different market participants out there, XTX, Jane Street, Citadel. These are different types of firms that are either have or are initiating client-facing, offerings to the end consumers of liquidity, the buy side. And how does the buy side access that? Is it direct, or is it through an intermediary? Mike and I certainly have overlapped in the alternative trading or ATS space over some years with different initiatives. There are offerings out there such as PureStream, One Chronos, and Intelligent Cross are three that continue to be a focus of my client base. And I know Mike, with his long experience in the ATS space, can speak more to that.
Sure. I think the ATS train definitely is rolling right along, and there's a lot of innovation in the space. And I agree with Jeff. The three that I hear most often asked about and discussed are One Chronos, PureStream, and Intelligent Cross right now. There are other new entrants that are in stealth mode that I'm aware of, and I think that we could say that there's 60 odd different destinations you can execute a trade at in the United States. Isn't that enough? But innovation keeps on creating new opportunities and new space. So I think this is a place where we could have a full podcast just talking about the differences among the various ATSs. One Chronos raised a ton of money recently. They raised $40 million in September. They're seeing very good volume growth. They're looking to expand into Europe. They leverage what they call smart market periodic auctions that prioritize best execution. And those are just non-bilateral trades. They're trades from a pool, to and from a pool. And I think the best analogy I could give you would be to think about the electricity market as an example of a smart market. And when you try to leverage that, that mathematical optimization, it can just really help increase efficiencies, reduce transaction costs, reduce friction, and lead to better execution outcomes. PureStream, another one, they use percentage-based orders to match at the parent company level or parent order level, which reduces information leakage and market impact. There are, as I mentioned, still other people that are coming in contemplating new launches, one of which I know is trying to bridge the gap between retail and institutional flow. And when Jeff was talking about the PM that wonders about, how come all this volume traded and, I didn't participate in all of it, a lot of it has to do with bridging that gap between institutional and retail flow. I want to focus on Intelligent Cross for a minute because I think there's some very important stuff happening there. Intelligent Cross, as you guys may know, is the fastest growing ATS in the US, and they lobbied recently to have their quotes listed as a protected quote on FINRA's ADF, the Alternative Display Facility. And why does that matter? Well, Intelligent Cross basically has two books. They've got a traditional dark pool, and then they've got Aspen, which is their lit pool. Aspen is the only lit pool that I'm aware of in the ATS space right now. Both pools use machine learning and AI to improve execution quality and the stability of the quote post-trade. Prices that are displayed in Aspen are not visible to most investors because those orders are not disseminated over the SIP. And therefore, they're not part of the NBBO. And so, ironically, the SEC had approved a FINRA rule change that would allow Intelligent Cross to display a protected quote back in August, and then they stayed the approval the very next day. So as such, these quotes are not available to people. So what can we do? Brokers can subscribe to Aspen as a free quote feed, and it can come into them via Exegy or any of the other type of quote service providers. But only about 30 brokers take that feed, and only a small number of those incorporate that feed into their order routing, which I find fascinating. And you might say, well, Mike, why does it matter? Well, 4.4 million times a day, an Aspen quote is better than the quotes that are displayed on the exchanges. That leads to about 106 million shares a day or 6.4 billion of daily value of SIP trades that were worse than Aspen's displayed quote. So that's a big deal, I think. And so since the stay, Intelligent Cross's quotes are traded through, on average, 478,000 times a day. So if you're an asset manager, you're a beneficial owner, and you're trying to get the very best prices you can get, it would behoove you to ask your brokers whether or not they're taking this feed. And if they are taking this feed, are they incorporating it into their quote mechanisms? And if they're not, it'd be fascinating to know why not. Hopefully, the SEC will lift the stay. Aspen's quotes will become part of the SIP. But until then, I think it's really worth asking that question.
And Sam, this concept, it's evolution, right? Evolution is moving quicker than certain regulatory bodies in reviewing and approving that evolution. And when you bring it back to the asset owner client, and what is that asset owner client? Who are they retaining? What asset manager? What hedge fund? What type of products are they leveraging? And then what type of tools is that asset manager engaging in the fiduciary responsibility that is obligatory for that asset manager to fulfill? So a lot of complexity, and it goes back to my original observation of the sophistication, the needed focus is higher than ever in engaging liquidity in the market.
Fantastic. Thanks both for that explanation. Appreciate the practical advice for how firms today can navigate this complex liquidity landscape. So some great stuff there. Obviously, amid all these challenges, there is an opportunity for investment technology providers, market data vendors to step in and provide some really targeted solutions to help market participants maintain their edge in this complex environment. Tell us what you guys are thinking about when it comes to those third-party providers and how they can best provide value today.
Sure, I'll start if it's okay. I think that what I'd focus on here, because there's so many different things we could focus on, we should focus on the OMS and EMS landscape, and there are some thoughts around what the biggest issues are, and then thoughts about stickiness. But I think if we talk about the biggest issues that OMS providers and their provide for their clients, we see clients asking about the need for fixed income order execution. Why fixed income? Well, there's just this, given the recent workflow automations that you've seen, much more efficient liquidity sourcing, the relatively still opaque market structure, demands for companies to create, for instance, a tape for corporate bonds. There's just a tremendous amount of demand to automate that space. Another big issue we see all the time is managing regulatory change. And the more global you get, the more regulators that you have to face off against, and the more your order management system provider has to be able to seamlessly produce solutions for you. To touch on globalization again, think about scalability, think about, again, regulatory harmonization, think about interoperability between systems. Another big issue is legacy tech issues. When you try to, a lot of people take an order management system and then they'll do hundreds and hundreds and hundreds of customizations over the course of the years that they've had that system. Well, that becomes incredibly difficult to upgrade because you have to go and regression test every single customization that you made that was specific to your company, and it just becomes prohibitively expensive to upgrade your system. So a vendor could sit there and say to you, I've got this great new portfolio trading algorithm, or I've got this great new swaps module that you can take, but you can't take it because you can't upgrade to the system. It costs you $1 million and take a year to upgrade your system to get to those new things. And then lastly, of course, is connectivity. And the more global we are, the more interconnected we are, and fixed connectivity is both I've described it as both a Trojan horse and a moat. And if you are an OMS provider that has absolutely excellent connectivity services, you will keep your competitors at bay. If you are a competitor that's trying to break in, and you can use your excellent connectivity resources to be a Trojan horse to get over that bridge and get into that client and start providing excellent services, it's an incredibly important strategic asset. So I would say those are probably the biggest kind of issues that I see. The other kind of interesting topic is stickiness, and Jeff can cover the stickiness part from the asset manager's perspective. From a vendor or broker's perspective, you want to make sure that you're the guy who wins in the event of a merger or a business combination or other competition. And vendors, having been one, I can tell you that vendors count on the difficulty of replacing mission critical software. They count on the fact that you're going to have to forego hard fought for customizations, your comfort with your day-to-day workflows. They rely on how much work and political capital a head of trading is going to have to spend to force the change of an OMS provider. And so the whole conversation really becomes, it's a devil you know versus the one you don't conundrum. But you still see firms changing providers every year. And why? Well, business models change. Firms close or merge. Look, for instance, at BNP Paribas, right? BNP Paribas brought Exxon, BNP, and Deutsche Bank's prime brokerage business all together over a number of years. And there are so many, first, harmonization of people, then brand, then culture, locations, and then technology. And those firms will have multiple different order management vendors that are all operating in those different businesses, that as they bring them together, someone ultimately has to win. And then lastly, product sets change, geography changes. So too does scalability, stability, and service. All of that matters, and it sometimes matters more than cost. So I'd say that while vendors will give discounts for term, there are much bigger issues at stake, as I hope I've described. And the last thought on the matter is that firms who underestimate the value of service excellence and responsiveness are going to lose.
Yeah, Sam, stickiness deserves an extra mention. Mike touched upon it, and it is real. Stickiness from the buy side means they're comfortable with the technology. Stickiness from the vendor means reoccurring revenue. Okay. And, I've lived through both sides of it from, a consumer of OMS and EMS solutions, gone through the assessment, analysis, needs, contract negotiation, and implementation of different OMSs and EMSs. And I'm seeing that on my, the client front that I have now. What's interesting is most leaders on the buy side want to live through one conversion in their career. All right, it's a one and done. That's their ideal. They don't want to live through the converting from one EMS or one OMS to a second one throughout their career. And I think there's a difference between, the whole build and buy. We've heard that a lot in the past. It's customize or configure, right? If a buy side has the ability, or a user of financial technology has the ability to customize, that makes it very difficult, as much as Mike touched upon earlier, is to upgrade to the next, version. So if you really think about the difference between customization and configuration. So configuration is working within the four walls of that version that the vendor is offering, and that when that vendor offers, version 2.0, then those configurations would naturally roll over into the upgraded version. And, I touched upon outsourcing in the past, and I think I'd be remiss by not bringing into some of the custodial firms out there, such as State Street, Northern Trust, or Bank of New York. And they're, the continued end-to-end offering from, custodial services to back middle office services, and morphing into front office and data services. And, State Street's Alpha product is a perfect example of front to back co-sourcing. And that's something that the industry continues to focus on and really think about, is, partnering with an entity like that, getting too close to one entity and having, vendor risk, or is there an offset to that vendor risk, and embracing and doing more with one vendor actually net beneficial, and going back to my earlier observation of sticking to the knitting.
Got it. Great explanations, both. Obviously some emerging and new challenges at play, but also seems that some tried and true principles of technology, of the technology vendor landscape, allowing for that customization and configuration, and providing excellent service. I mean, some of those things aren't going away anytime soon, will not, and good to hear that the value of that is reaffirmed amid all of the challenges that the industry is facing. Thank you both for that. I want to shift gears a little bit now, and talk about some of the other things that you guys work on in addition to your core consulting work. So, Mike, I see that you're on the board of Newton, which is a green energy company focused on electric vehicles. Tell us a bit about that. Are you an electric vehicle enthusiast yourself, and how did you get introduced to that company?
It's a great question. I would say that Jeff is by far the greater enthusiast of the electric vehicle space than I. The way I was involved in it actually came about as a result of my consulting. And during I had a year-long stint at a major custodial bank, and one of the principals there invited me, or asked me if I'd be willing to be on the board of a SPAC. And I'd never been on the board of a public company. I'd been on the board of several private companies or strategic investments that my firms had made over the years. And I thought that public board service would be a really interesting avenue to pursue. And so I joined the board of a SPAC called Eastone Acquisition Corporation. We went through the process of identifying targets to acquire during our our term. And we came across one company that we had to move away from because we just couldn't get SEC approval. And it's not that the SEC won't approve or disapprove, they just keep asking questions. They ask so many questions that you just know you're never going to get through. So we moved away from that company, and we found Newton Motors. And Newton is it's a fascinating company. They're based in Dubai. They are working very hard. They're delivering their first cars now. They have very novel concepts in terms of the the customer's experience. So autonomous driving is part of it, the design of the cabin, the software that's inside the cabin, and then also all the innovations around extended battery life and range and so forth come into play. They have, so we de-SPACed Eaststone Acquisition Corporation into Newton, and I was invited to be one of the independent directors of Newton. So for me, the learning curve is incredibly steep. Every day I learn something new. And where I try to help them from a capital markets perspective is to understand the difference and the nuances of the relationship between the warrants and the shares and how arbitrageurs are playing that. And then also to help them understand what it's like to go from being a private company in Dubai to being part of the United States capital markets ecosystem and the differences that they need to embrace when they want to comport themselves in this marketplace.
That's great. Obviously, a topic that will only grow in importance as we move down the line. So really interesting to hear a little background there. Well, we're just about at time. Thank you both for a fantastic discussion today. I certainly learned a lot, and I hope that our listeners came away with some new ideas about the challenges in store for 2024, some of the complexities of the liquidity landscape today, and how technology can help solve some of these challenges at hand. So if you'd like to learn more about Jeff's business, you can go to EstellaLLC.com. If you'd like to learn more about Mike's business, you can go to capmarketsiq.com. And for more episodes of At the Forefront, just like this one, forefrontcomms.com. That's forefrontcomms with 2 M's.com. Again, thank you both for joining. Thanks to our listeners for tuning in today. And until next time.